Hey everyone, Oracle has been one of the best performing stocks in the market in 2024, rising to $139 per share, up from a little less than $106 per share to begin the year. So understandably, a lot of investors are curious about what's going on with Oracle. So I thought I'd share some details about the latest developments at Oracle in this video here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so in the latest quarter, Oracle said that it signed the largest sales contract in their history, led by huge demand for training large language models. Oracle is benefiting from the rising effectiveness of artificial intelligence, being that it is one of the larger cloud providers worldwide. RPO, which stands for Remaining Performance Obligations, came in at $98 billion, which was up about $18 billion from the previous quarter and up about 44% from $68 billion last year. So they experienced an $18 billion increase quarter over quarter, reflecting the magnitude of the contracts signed during the quarter. The company is trading one-time non-recurring license revenue in return for much bigger strategic customer commitments for multi-year revenue from which they expect to further accelerate revenue growth. In other words, to remove all of that jargon, what they're doing is changing their sales tactics. Previously, they sold licensing commitments where someone bought a license to operate their software for 1 year, whatever the case might be. Now they're changing that to recurring revenue models, saying, sign up with the deal with us and we'll charge you, let's say, $100 per month going forward. 6-year deal, 10-year deal, whatever the case might be. But instead of a one-time purchase, Oracle is shifting those commitments to longer-term contracts, longer-term recurring revenue. Not unlike previously, remember, you used to be buying DVDs to watch the movie, and that has now shifted. Instead of buying a DVD, you're subscribing to Netflix. So you're paying every month to consume content, similar to what Oracle is trying to do here, shift consumption patterns from one-time purchase to monthly or annual commitments. So given those trends, the management team feels that their growth rates will only continue to get stronger and accelerate. So you can understand, because of this optimism, why the stock price is performing as well as it has, jumping up to $139 per share, up from less than $108 per share to start the year. Oracle goes on to say that they signed over 30 AI contracts for over $12 billion this quarter, and so far $17 billion this year. And investors are excited about artificial intelligence and are willing to invest in companies that are benefiting from the growth of AI, Oracle being one of those companies. Investors are getting more and more interested in Oracle stock. Of course, I recently recommended Oracle stock as a buy, and I updated that recommendation and reiterated it on June 5th, recommending Oracle stock as a buy, and I updated it on June 5th following the company's latest quarterly earnings results. I reiterated that buy recommendation. Management continues to say that I'm pleased to announce that we've signed another multi-cloud partnership, this time with Google. Google Cloud Network will interconnect with Oracle Cloud, and it's available immediately in 10 regions and will be live with Oracle Database at Google Cloud in September. This helps enterprises commingle their various services and makes it more convenient. Enterprises today have services and purchase commitments from several companies, including Google and Oracle and AWS and others, and it's more helpful for enterprises when these services are connected so that they are better able to transfer data between the clouds and better able to move their services between the clouds. So this should help businesses add more convenience, and these relationships are good news overall for the industry. Now, getting into the details, their total cloud revenue, that is software as a service and infrastructure as a service, excluding their latest acquisition of Cerner, was $4.7 billion, which was up 23% year over year. And were it not for continuing supply constraints, consumption growth would have been even higher. Management has talked extensively that they're constrained. They have more demand than they have supply, and their contract signings are already exploding. And if they had the supply, they would be able to generate significantly more revenue. Investors love to hear that when companies have more demand than they have supply, and even as they increase supply, demand continues to grow. That's a great sign for a company. So something that's very important is that on-premise databases are migrating to the cloud. And this has been happening for several years now. And I think the rising effectiveness of artificial intelligence is only going to increase this migration, where companies are moving their IT from on-premises over to the cloud. And this way they can be more mobile with their technology, with their cloud, with their data. And on top of that, the consumption model, the payment, is more convenient for businesses, especially smaller businesses, because instead of paying a large upfront cost to build out your IT, you can pay monthly or annually or quarterly and get the same type of performance. Sure, you might pay a little bit more per unit of consumption versus if you had it on premise, but the difference would be the on premise, you would have to pay the large upfront cost, whereas on the cloud, you can convert that into a monthly or annual consumption fee basis. So because of this migration, their software license revenue was down 14% to $1.8 billion. They're replacing these on-premise deals for cloud deals. Operating income jumped 9% to $6.7 billion, and operating margin of 47% was up from 44% last year. As they continue to drive more efficiencies, looking forward, we continue to benefit from economies in scale. We will not only grow our operating income, but we will also expand our operating margin percentage. This is excellent to hear. Businesses, as they grow their revenue, I expect them to improve their operating profit margin. I expect them to get better at whatever it is that they're doing. I expect them to leverage some of their fixed costs, right? Some of their costs are fixed, right? You pay a fixed salary for your employees. You pay a fixed amount for your rent and lease for your office space and other infrastructure. And so as your revenue grows, some of those costs should stay the same and thereby create larger profitability as your revenue grows and your costs stay the same. I expect businesses to do that. And businesses that are not doing that, I tend to not be interested, or I downgrade them when I'm considering them as recommendations or considering them as investments. Oracle is demonstrating that expanding operating profit margin, and 47% is an excellent operating profit margin to be sure. So I hope this explains a little about why Oracle stock price is climbing and the inner workings at Oracle. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.